The Intelligent Investor by Benjamin Graham. In 1949, the chief executive of IBM set as a goal that all the moving parts of IBM products would switch from mechanical to electrical in the next decade. Not only was that goal met, but by the mid-1950s, IBM was aiming to ditch vacuum tubes for circuitry and be solid state by 58. Also, in 1949, the Soviet Union exploded its first atomic bomb, fueling the Cold War for decades to come. And at home in 1949, more and more families were buying televisions and cars. Believe it or not, that same year Benjamin Graham published the first edition of The Intelligent Investor. Amazingly, while everything from solid state to the Cold War are now obsolete, his wisdom on intelligent investing continues to be respected. Graham updated The Intelligent Investor in 1973, shortly before his death. His legacy certainly lives on. Even today, nearly 50 years after this revision, the book is still considered by many to be the best book ever written on investing. Its greatness is not only because the investment strategies have proven true in the long haul, but because Graham promotes an understanding of character traits that may be truly timeless. Therefore, his book has appeal not only for investors, but for the common person trying to succeed in life. Graham begins with the premise that the market can be characterized as an unstable person, volatile and unpredictable. As such, the market's ups and downs don't always correlate with what is truly going on. Basing your investing solely on the market value of stock, therefore, is unwise. Speculators that allow themselves to be influenced by the unstable market's ups and downs end up acting with either fear or greed. Not only are these unattractive characteristics, but the frantic trading done by speculators is often short-sighted and doomed to fail in the long run. Instead, if you are serious about investing, you need to assess yourself and count the costs and risks you are comfortable with. As opposed to speculators, investors are patient, disciplined, and willing to learn new things. As an investor, you are willing to spend time and energy to make investing succeed. You are humble, realizing that you really can't control the future, and often you can't even predict it accurately. So, you make investments based on solid data collected over the long run. While speculators are tossed about by panic and frenzy, you don't follow the crowd. You are willing to think on your own and control your emotions. While those character traits would likely lead to success in most of life's arenas, they can particularly make you a successful investor. Based on your assessment of your overall personality and the time you have to spend on your portfolio, you should choose one of two paths of investing. 1. The defensive investor, more passive. Or 2. The enterprising investor, more active. Both are productive and successful approaches and much superior to the frantic speculators' haphazard buying and selling. The main difference is the time involved and the energy expended. More people have limited time and energy, so are better suited to be defensive investors. Both strategies put you on the path of sustainable, long-term growth for your funds. Note that neither of these two main types of investors are focused on getting rich quickly. Whether a defensive or enterprising investor, you are in it for the long haul. The defensive investor. If you are a defensive investor, you are more passive, setting up a portfolio that fits certain criteria in predetermined proportions. The suggestion is 50% stocks and 50% bonds, rebalancing annually or semi-annually. You should invest in 10 to 30 companies to assure diversification, drawing from various industries and favoring larger companies. To assure that you are investing conservatively, look for these standards in the companies that you choose. At least twice as much, 200%, in assets over liabilities. Dividends paid out consistently for the last 20 years. Earning growth of 33% or more over the last 10 years with no earning deficit over that time. Affordable stock that is not more than 1.5 times the company's net assets. And showing a P/E, price to earnings ratio, of 15 or less over the last year. After setup, the defensive investor puts in much less energy and the portfolio runs nearly autonomously. Key to success is making routine investments at regular intervals, perhaps a certain amount put in each month. This is known as dollar cost averaging. While the line graph of the stocks you invest in will have peaks and valleys, the line rises over time. Because you are investing bit by bit at regular intervals, you are not affected by the instability of the market. It evens out over time, making this strategy sustainable with long-term benefits. The enterprising investor. This strategy is just as legitimate as the defensive strategy, but it takes a different personality, a much greater investment of time and energy, and a willingness to learn and research extensively. As an enterprising investor, you constantly research stocks, bonds, and mutual funds. The goal is to know the investment possibilities so that you don't get sucked into current trends just because they're popular. The enterprising investor should follow standards as well in choosing stock companies. As an enterprising investor, you are not constrained to a specific number of companies or tending to their size as strictly as a defensive investor would. Note how these standards for choosing companies differ and are somewhat less conservative. As low as 150% asset to liabilities ratio. Dividends paid in the past year. No earning deficit in the past 5 years and at least some growth over that time. And market cap of less than 1.2. In addition, you are not constrained by a set P/E ratio. Whichever type of investor you are, longevity and sustainability of growth are the primary goals. You need to remember that your stock is partial ownership of a particular company. As such, stock is more than ups and downs and chances to make or lose money. Your decisions are serious and should be guided by these 3 basic principles. You are responsible for thorough analysis of the fundamentals. You protect yourself from severe losses. You have realistic expectations. Following these principles, you are not in a hurry. You do not expect to peak quickly, and you won't be skidding into valleys unexpectedly. You also do not choose a company because you are familiar with it. Just because you love Nike shoes doesn't mean it would be the best choice for investment. Here again is a concept that goes beyond investing. Psychologists have proven that familiarity leads to confidence and trust, regardless of the facts. When it comes to stocks, studying data and making sure the company fits sound investing strategies is more solid than loving the feel of the shoe. Whether you are an experienced investor, someone new on the investment scene, or someone just looking to succeed in life, Benjamin Graham has some advice worthy of your attention. While market value is certainly finite, the value of the good character traits he promotes are timeless. No wonder this book is still so highly regarded.